Hello, everybody. So today I want to talk about two trendy stocks. Trendy in quotation marks, right? That's kind of my judgment that Celsius beverages, Celsius energy drinks, and On running shoes are trendy. Maybe you don't agree with that assessment. But anyways, I see these products everywhere in the real world. I see a bunch of people buying Celsius, at the warehouse store, at the gas station. And of course, the On running shoes, they are very distinguishable. And you may be seeing it, people, in cities, in airports, everywhere. We are seeing these shoes. I'm seeing these shoes everywhere. And yet these two stocks, I find dirt cheap. I don't understand why these stocks are being ignored. I don't get it. I don't get it. I just don't get it. Maybe it has to do with the Middle East. Maybe people think that, I don't know, the energy drink market is going to be impacted with the Middle East. I don't get it. As we see everything rebound, these two have not rebounded. They've not rebounded. So if I look at Celsius, for example, it's still down, nearly 50% in the past 6 months. It's at the low year to date. The low of the past 6 months, $33. I think it's down again today, by the way. And I absolutely don't understand, because if you actually look at Celsius's combined company, so remember, it's Celsius and it's Alani Nu. Celsius and Alani Nu. I've been covering this stock for a little while. You may remember years ago when this stock was more expensive, the big fear was Alani Nu was going to disrupt Celsius. Then we had the best news ever. Celsius buys Alani Nu. I also remember they didn't pay that much. That was a really good deal. They are now a combined company. They are now growing super fast. And the stock is trading, it's been more than halved. Like it hasn't recovered. It makes really no sense to me. And so if you look at the revenue, if you ignore the quarters, was it from 24 months ago to like 12 months ago, where they had distribution changes with Pepsi, and then they added Alani, and then they also built their own facility. So the revenue growth is actually murky if you go back, 2 years to a year ago. Right, that was the only blip. But the revenue growth does not reflect the underlying sales at the point of sale. The sales at the point of sale have been just steadily growing. Just steadily growing, to the fact that if I remove this and if I show you this and you were to ignore the distribution changes, you can see the growth curve, the growth line is stellar. It's only up. Yet the stock is just absolutely not reflecting the success of Celsius. So I do not get this valuation for Celsius. Enterprise value over gross profit over revenue growth is a 0.17. The rule of 40 is a 63. Company is predicted to grow sales next 12 months at 40%. The margin is excellent, 51%. EBITDA margin, 23%. They are printing cash. This is a company that is printing cash. And I don't understand how cheap this valuation is when you consider that this company is in a sector that is usually well understood by Wall Street. It's a usually well understood sector by Wall Street. I guess Wall Street doesn't get Celsius. I don't know. But it's a sector that's usually well understood. It's the retail category, it's the energy drink category. You're selling this stuff through Costco, through Walmart, through gas station, through convenience store. All of the stuff that traditional folks are supposed to understand. And this stock also has the precedent of what happened to Monster, of course. Whenever I talk about Celsius, I have to talk about Monster. Monster is one of these rare stocks where if you go since the IPO, they've actually greatly outperformed the NASDAQ. But even if you look at Monster compared to the NASDAQ during the very strong period of the NASDAQ, right? So ignoring the 2000s, starting from 2010 to today, the 16 years, over 16 years, you have Monster also outperforming the NASDAQ with 22 times your money and 15 times your money. And you may be like, why am I talking about Monster? We're not talking about Monster today. Yeah, I'm talking about Monster because if Monster is any indication of how powerful this category is, we should take note of the fact that Celsius has handsomely beat Monster for the past 6 years. In fact, Celsius return the past 6 years is 62% annualized versus Monster only 15% annualized. The past 6 years, Monster has been trading roughly in line with the NASDAQ. Celsius has taken off. Celsius is the hot beverage right now. And the market is entirely sleeping on Celsius. You know, I think the recent drawdown on Celsius has something to do with the Costco copycat, or the Costco dupe, as you know, Gen Z loves to call it. Apparently, Aldi also has a dupe. But I mean, to me, that doesn't do it. Like, I don't buy that. I don't buy that at all. I mean, there's always been quote unquote dupes. You know, like Coca-Cola, Pepsi. They have a bunch of dupes, right? Every single store brand tries to launch their own. To me, it's just breadcrumbs. These dupes, as they call them, they're just gonna take breadcrumbs to me. Like, the main brand, you know, has almost become in certain circles a status symbol, especially Alani Nu. I want to point out that Alani Nu and Celsius, they have a very unique category in the energy drink sector. You know, first of all, I would argue these two, so Alani Nu is like 95% female. Celsius is, it's more gender neutral, although you could say that some of the marketing has been more women oriented lately, but not even sure. Like orange, like a Celsius orange, that's very gender neutral. So the point I'm trying to make here is that while a beverage like a Red Bull or a Monster is not socially acceptable, for example, to be had in the morning, Celsius is socially acceptable to be had in the morning, and so is Alani, socially acceptable to be had in the morning. Red Bull, Monster, not so much. And I always quote this because I remember one time stopping by a Buc-ee's and I saw like a bunch of women waiting in line at 7 a.m. in the morning to buy a Celsius. And I was like, that was a click in my mind. I was like, okay, there's something going on with this brand. This brand is resonating with the Gen Z consumer in a way that coffee just isn't, right? Because, you know, people my generation, in the morning, you go to a gas station, you get a coffee, right? Not the new generation. They get a Celsius, they get an Alani, but they don't get a Monster. And I think that's a major, major difference. So to me, plus the health positioning, plus the recession-proof aspect, because I actually, the other day, I went to Sam's Club, bought Celsius. I didn't think it was that expensive. I bought like a 24-pack for, was it $15 or $18? They were on sale. It wasn't that expensive. So it's recession-proof. It's not that expensive of a beverage. So I don't think that's something that a recession will impact. Like, sure, I guess it's a little more expensive than making coffee at home, but it's really not that expensive. And it's super high margin. So I just don't get it. I don't get why it's so cheap. I don't get it. Wall Street is just the way it is. They also had a third attack from like a teenager suing an energy drink. But if you actually read the lawsuit that was for a distributor. It was not against Celsius. But the market, news by association, they tried to take the stock down. I have no idea. Maybe the stock is manipulated. I don't know. Moving on to another stock that I don't understand why it's so cheap. On running. So on running is pretty much trading at the same price as it was an IPO, during IPO. And I would argue that much of the hurt that Nike has been going through has to do with on running and maybe to a lesser extent Hoka. Reading online, a lot of people are saying that Hoka is not as good as it used to be. I really don't know. I don't buy expensive shoes, so I really don't know. But On, in my book, seems to be winning as far as picking a stock goes, because the point of discussing whether Hoka is successful or not is moot, because Hoka is owned by a bigger company that has other things that I don't really want to invest in. So Hoka is out of the picture because it's not a pure play. Right, but if I were to take a pure play on a stock that is hurting Nike, and perhaps a pure play on the decline of Nike, maybe I would look at On running. I also don't understand. The stock is flat. The revenue 3x. So the sales have 3x, and it's so consistent. Like the success. Look at since March 2022 to 2026, last quarter reported. Just look at the consistency of the sales. It's so consistent. No bump in the road, and the stock is flat. So this crazy market again throwing us a deal. I absolutely don't get it. The margin, of course, is outstanding on this stock. Gross margin is 63%. Keep in mind, this is not software. This is tangible, right? EBITDA margin is lower at 14%, but still pretty darn good. Keep in mind, whether it's Celsius or whether it's ONON, these are companies that invest a lot in marketing to gain those sales. And I generally happen to believe that investing in marketing is actually very helpful for these companies, because if you want to create a brand, if you want to be well known, I look at marketing as an investment, because these are all repeat purchases. Obviously, caffeine, right? Caffeine in a can is a repeat purchase because of the way biology works. And once you start having caffeine, you need to keep having caffeine. And, obviously, this is also, I also look at running shoes or shoes in general as a repeat purchase, because shoes don't last a very long time, right? Shoes, they will wear, right? And if your shoe wears, you have to replace it. So shoes in many ways are closer to it's a consumable. Right? A shoe doesn't last forever, especially modern shoes, right? And so this is also. You could look at it as $160 drop. Every year, somebody who is on shoes, they might buy a pair of shoes a year, right? So it's almost like a recurring revenue in my view. These are expensive shoes, and they make a lot of money. And so I absolutely don't understand. So maybe the stock, I think, on running is down, maybe because Wall Street kind of trade on headlines, and they do this very advanced analysis where they say CEO stepping down bad, and so they drop your stock. But if you actually look at the CEO change, first of all, it was announced a long time ago, and I think their CEO is going on a long time announced sabbatical, something like that. And the founders are coming back. So the founders coming back to lead the business, in my view, is quite bullish. In my view, it's not bearish, especially when the CEO is leaving after having announced to the stock. So, and anyways, I believe strategy, I believe product matters much more than leadership. And to me, a great company will continue to be great even with an average CEO. To me, it takes a really, really bad CEO to kill a business. I'm not of a school of thought that the CEO of everything. I think the product is everything. I think you had put the best CEO in the world at the head of Sears in 2016. There's nothing that CEO could have done. So I don't understand why the market is hurting it like that. Stock is too cheap. 0.18 on EV over GP over RG. Rule of 40 is a 41. When I see so many stocks trading at a 1.5 on EV over GP, I'm like, I don't interested in that. I want to have cheap growth, right? And actually, when I look at my trailing 12-month revenue, the sales are more closer to 3.5 times as high as they were 4 years ago, and the stock is flat. So unbelievable. That's what it is. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.